And then now we will move to the second elevator speech, or the keynote speech, and this will be delivered by Dr. Helena Naffa, who's the Associate Professor of Corvinus, University of Budapest, and who will talk to us about the paradigm shift in sustainable finance. The floor is yours.
Thank you. In 2015, the top 3 academic journals in finance had 0 mention of climate change, whereas other sciences, social sciences, economics, and environmental sciences have gone a good way of shifting the topic from niche into mainstream. And we have a lot to do in finance research as academics to level up with the other sciences. There is a dire need for empirical findings and developments of economic models. But as we emerged from the pandemic, we were faced with a new world order. There's a war waged by Russia against the Ukraine. We are faced with elevated inflation. Food prices have soared. Lending is very expensive. And that has led to socioeconomic struggles for many layers of society. And across the globe, we are seeing elevated geopolitical tensions. In the United States, the topic of sustainability is under the crossfire of politics. And there is a dire need to progress with scientific findings. We've spoken about sustainable growth in this conference. This is an oxymoron, 2 conflicting terms. How can we grow sustainably, endlessly? Let's change that terminology with sustainable development. And let's consider other ways of achieving sustainability. Degrowth was brought up as a viable alternative. So we identified what are the dire questions that need to be answered by academia in finance to the pertinent questions that are faced by the industry and by decision makers and the regulatory. The first pillar is disambiguating the confusion that we read in the literature. There were very interesting talks in this summit and even very conflicting debates on the need for standardization of the ways we measure sustainability, of the ways we present the data. Is it useful to have heterogeneous opinions, or is it just adding to the aggregate confusion as we read it from the MIT paper? But we believe that we need to enhance the economic models to incorporate the consideration of sustainability. In the classical utility function of investors, if you add the layer of sustainability, how does that shift the priorities? This is what we're trying to achieve and trying to understand where are the differences stemming from investors some of them who can generate alpha, extra returns from aligning investments according to ESG preferences, and others just believe that and see that there is a pricing bubble in these ESG assets. One hypothesis I'm considering with my fellow researchers is that there are 2 groups of investors. Some of them are ESG motivated, while the others are ESG aware. And the motivated ones usually have a longer investment horizon, a long duration, if you like. And with that long duration, we are talking about investors such as pension funds or sovereign wealth funds. Usually, the observation on the market shows that this group is less active in trading. Hence, the opinion of the short-termed, short-sighted traders is the one that's registered into asset prices. So you see the asset pricing bubbles in ESG assets. And what this long-term vision group has done is that they realize if they want to voice their opinion, then they have to shift from the trading floor, from the trading room, onto the boardroom. And as they are the majority of the asset owners, so not in volume terms, but in assets under management terms, they have the upper hand. New techniques, new strategies of implementing sustainability aspects are emerging. We'd like to replace the very simplistic exclusionary policies with engagement, with active ownership. And this brings the other question, which pertains to risk management. A lot of the companies see the value in sustainable finance in managing the new types of risks they are facing. Climate risk is one, but greenwashing is another one, which is more and more important, related to reputational risk. Some research findings from my colleagues have shown that if the governance of companies are up to a good standard, then that has shown that it's very much related and a very good predictor of potential and future operational losses. So that's one extra layer of additional benefit to that. And finally, we think that how to manage the risks in looking at the empirical evidence is very much empirical-based and data-driven. So we are building unique and large data sets with our partners who are providers of the data to enable us to give more insights to the industry. And finally, we're seeking solutions of how to implement the ESG strategies, the sustainability investment goals, how to allow investors to align financial value along with their own investment values. So we want to explore what is the extent and what are the limitations to each of these strategies. The very typical strategy is simply ignoring the companies that are not aligned. This is the negative screening strategy. But that's like shoving the problem under the carpet and not dealing with the problem. So the focus is more on integrating ESG considerations, looking at progress. Where is CapEx, capital expenditure, going to? Is it aligned with sustainable activities? And taking it further down the line to focus on stewardship, active ownership, and engagement. We are conducting this research with 15 of my fellow researchers across 4 universities, and we are seeking out partnerships to facilitate our conduct our academic research. Thank you very much.
Thank you very much, Helena. It's actually amazing to see that research like that is happening here in the region in Central Europe, and you're doing a really, really good job. So if anyone would like to maybe participate or support the research, which is really useful for, I think, for the market overall, and actually for all the actors in the market, definitely speak to Helena later as well. So thank you so much for that.